Okay, it's Tuesday the 11th of October. We're just at quarter to 11 and we are on the Ftse 100. So for the live trades, what I'm doing now is I'm splitting the live trades from the review videos so people can get to the information they want a little bit quicker. So if you want to see the overall market analysis for today, you can watch the Ftse review video, and that's what I look at in the morning, and then I trade on the back of that analysis basically. So the reason for this live trade, I've just been triggered into it and loaded up the recording software, and the main reason is because my entry point was not exactly where I wanted it. So basically I clicked to enter the trade. As I clicked, the market spurted up just a little bit, and it triggered me in at not an ideal level. So really I wanted to get in around about 7101, and then I wanted to watch just for reactions up at the green line right here at sort of 7104, with the reason being I'm just stalled here at these levels. So I got triggered in higher up, and so now basically what I have to do is be a little bit tighter with my trade management. So if the trade starts to move against me now, reacting off of these levels, well, first of all, I would really like to see the Ftse reach at a minimum up at these highs, 7110, and really up into these levels, with an overall target being up at the previous highs. However, when you're in a trade, if you see the market moving against you, if it is at your technical levels, so if it's at the levels that you've already identified where you want to watch for potential, in this case, bearish sentiment, if you start to see it, you have to be willing to get out of your trade. If that's your analysis, and if that's what you decide before you get in the trade. So my analysis before I entered this trade was I want to watch these levels, 7104.4 sort of and higher. I want to watch these levels for those reactions. If I see those reactions, well, the intention was to jump out for break even, maybe 1 point profit. However, now it will likely be for a few points of loss. It's very important that you're willing to do this. For some reason, it's very common to hold on to a trade even if it's gone against everything that you've decided. So if you've done your analysis, you've said if this, then this, if I see this, then I'll do this, and then as soon as you click to enter, all of that goes out of the window and you just sit on your hands, or if this market moves against you, you sit and you bite your nails and you pull your hair and you stress and you convince yourself that eventually, even although the market is plummeting, even although it's broken the key levels you were watching, even although it's already reacted to the levels that you were watching and had decided would be the areas where if you've seen those reactions you would exit, you just keep holding on because surely, eventually the market will reverse and come back up. The worst thing that can happen when you trade like this is it works. So you just hold on as the market comes all the way down, all the way down, all the way down, and then eventually it does find a base and it does come back up. And you end up getting out of the trade at break even, or maybe you get out of the trade for a little bit of profit. What happens as you go into your next trades is that situation is now in your subconscious. You've seen it work when you ignored your rules. You've seen it work when you ignored what the market is telling you. And so why would you want to lose money? Why would you get out of a trade for a loss when on previous occasions you just had to wait it out and deal with a little bit of stress, and then the market comes back and you make your profit, or you get out of the trade for break even? Fine, it might work 5 times, it might work 10 times, it might work 15 times. But then eventually you're going to hit a market that is trending. You're going to hit a market. Let me just delete these lines. Okay, so you're basically going to hit a market that's trending. Let's say you're going to enter up here into a buy position. Market moves a little bit in your favor, and then it just collapses. It just keeps going and going and going. You decide at the end of the day, I'm just going to hold on to this trade. Because surely tomorrow it will retrace. The next day it plummets, and now you're potentially losing so much money that you can't afford to lose it, or it's going to really hurt to lose it. So you hold on. The next day, down it goes. Now 75% of your account, as soon as you close that trade, is going to be wiped out. So you hold on. The next day, comes back up, retraces. Oh, you've done the right thing. It's going to come back up. You're going to get out of this trade. Everything's going to be okay. Next day, continues to go down. And eventually, you are going to have to close that trade out. You're going to have to take the loss. And essentially, you're going to destroy your account. It's not a good way to trade. It's definitely not a sustainable way to trade. You have to be willing to take a loss. Now, the loss has to make sense. You don't just want to jump out of a market as soon as it starts to move against you, because a market is made up of buyers and sellers. There's never going to be a market that just moves straight up and just moves straight down. When it's going up, there's always going to be sellers trying to jump into the market. When it's going down, there's always going to be buyers trying to step into the market. The further down the time frames you go, the more you are going to see that in the candles. So no matter what time frame you're on, the candles as they're forming, they're going to be jumping up, jumping down, jumping up, jumping down. But on the lower time frames, looking at the candles after they've formed, you can clearly see the battles going on. You can see the sellers coming in, you can see the buyers, the sellers, the buyers, the sellers, buyers, sellers, buyers, sellers, over and over and over and over and over again. And that's what you have to deal with when you are trading on lower time frames. You need to be able to deal with that, first of all, and you need to have a trading plan that allows you to trade effectively on these time frames. Okay, so we're just watching the trade now. I'm just looking for, certainly not this, it needs to be a stronger bearish reaction than this. But we are up at management points. As I've mentioned, the reason for the trade is I got triggered in a little bit worse than I expected, that I wanted to be. So now I need to actively manage this trade. Okay, so I'll likely pause the video rather than having on, however long this video is going to take, and I'll just turn it back on when I'm making decisions or when the market is doing something that I can take you over. Okay, so nothing has really changed. We're just sitting at this area and the market hasn't really gone anywhere. Right here at 11 o'clock, you can see we spiked down. However, it has then closed all the way back up. And it's just really, the market is in a very, very short-term, small range. If you've got a management point like this, and you've also got a buy position, which means there is a reason for buyers to get into the market, when you get to these areas, the market will pause until there is a leading sentiment. So until the bullish sentiment takes over or the bearish sentiment takes over. At 11 o'clock, when it spiked down, you've got to remember this candle was completely red as it was forming and very bearish. So it's important not to make decisions whilst your candle is forming, because every pin bar on the chart at one point looked like a solid candle. So right here, a pin bar 840. As this was forming, this looked incredibly bearish. However, it then closed back up into a pin bar. So you always want to wait for your candles to fully form. I tend to find the last sort of minute to 30 seconds of the 5 minute candles is when they decide what they're going to do. Basically, it's when the last spurt of movement comes in to the market, and they either become the pin bar or they become the engulfing candle or whatever it is you are looking for. So I'm just watching for the reactions from here and for some bearish sentiment. If I get the bearish sentiment that I'm looking for, I will just simply come out of the trade at whatever point I am at. It's more important for me to do that, to follow the analysis that I did before I got into the trade, rather than trying to squeeze out profit from every single trade. It's a lot more important that you're able to follow those rules and trade effectively rather than trying to profit from every single trade you take. Because first of all, it's impossible. You're not going to profit from every single trade. It's just not going to happen. The best we can do as traders is profit more than we lose. And that is all a professional trader is, someone who makes more profit than loses. Okay, so the trade is still running. What I'm going to do is just take you through the setup so you can see my thinking behind the trade. So in the morning, we spiked up very, very strongly. The Ftse actually approached the all-time highs. So the highest price the Ftse has ever traded. Sellers stepped in at these levels. You can actually see the little red arrow here. I just put these in at levels that I am most interested in watching for trades, just as a little visual reminder when I jump back onto the charts when an alarm goes off. I can quickly see, oh, this is one of the key levels that I want to watch. Unfortunately, market just didn't reach it, just didn't produce the sell signals, came all the way back down into key levels right here. It failed to break out of these key levels, and then it produced a very nice buy signal at 10.15. For me, I was happy to get into this market after this signal. I missed the 10.30, which is when it popped up and would have been my entry. Came back when this candle was down here. And for me, I don't like to enter when the market is moving against the trade, even if it can be considered a retrace, whatever. I always like my entries to be above for a buy signal. So I just waited for what is essentially a second confirmation. The market came back up, broke the high. I entered into the trade. The market's just spiked up a little bit, and my entry has not been ideal. But the reason for the video is to go over the trade because of this, and to show you how I look at the trades when this happens. So basically, you have your trade analysis before you enter the trade. You have your targets, you have your management points, whatever you want to call them, already set. You know what you're looking for. You know what your stop's going to be, etc. And then if something like this happens, you have to be able to adapt. So for me, the adapting is quite simple. Instead of having, really entry should have been down here somewhere, 7099, maybe 7100. It's just been a few points higher, which means I didn't have the room to the management point. Because of that, I couldn't watch for the reactions as it came up there and then came back down, allowing me to exit for break even or very small profit. The potential now is I exit for break even or more likely a very small loss if this moves against me. You need to be able to do this. You need to be able to accept that, and just trade around anything that pops up. So not every trade's going to be absolutely perfect. Not every trade's going to work just exactly how you want it to play out. And when that happens, you just need to adapt. You just need to figure out what's changed, figure out what you need to change, and then just trade around it. So I'm just watching these levels now, and we have tried to break up. It's just fallen back, still in the management area. Sellers have stepped in. It's once again been rejected at level. I'm more than happy to stay in this trade. Okay, so the market has just shot up relatively quickly there. All I've done is closed out partial profits. We're at the first area. So that's profit locked in. I'm not going to let the market move against me strongly now. I'm just watching. Second target really is up toward these levels. However, I will close this trade out if we start to see reactions here now. Okay, so we're just coming into the last 30 seconds of the candle. I'm just watching it now. If we maintain what we're doing and just keep popping up and popping down at this level, I will likely close it. If we can shoot up into 7117, 7118 levels, I'll close that for profit also. So for this trade, basically 75% was closed here. The remainder will be closed up towards the highs. Reason for showing the trade, as mentioned, was the poor entry. But you're lucky if you get a bad entry. I don't even know, maybe once every 4, 5, 6 months. It's such a rare occurrence that it's just something that you just accept and move on from. I'm not going to start screaming about brokers saying they're rigging the markets, trying to shake me out of trades. It just happens. It could be anything. It could be my internet just slowed down a touch. The order just went through a little bit slowly. But there you go. The important point was altering the trade. Altering what I was looking at. Sorry, I just closed out the second position there for around about 12 points. Yeah, the important part was being able to adapt when you're in the trade. For zone traders out there, the way I was just looking for the market to give me a signal to exit, it's just the exact same as if you were running your profits, just looking for the same sort of signs as that. So profitable trade, it's even when you get a bad entry like that, it's important you just follow your trading plan. For me, I know that the methods of zone trader that I use every day, I know they work. So if because of a poor entry, I need to perhaps take a couple of points loss, I'm more than happy to do that because I know I'm still more than profitable overall. Okay, guys, so hopefully that was helpful. As always, I'm James Orr, and thank you.